Ashley. Yeah, we change the names of things and it makes it hard, huh, to always remember what to say on everything there. So, anyways, when we did this a couple days ago, I said, you look at the haircut that I had on the picture out there on the front, and it looked a lot better than what it was. But guess what? Today I got to get a haircut. So after 8 weeks of shaggy hair, so good stuff. I'm going to start this out by just giving you a little bit of background on myself. We'll tell you a little bit about the company, and then we'll jump right into what we do, and then we can take any questions and answer those as needed. So I was born and raised here in Reno. Been here all my life. My whole family lives out here. I've got 4 kids. I've been married to my wife now coming up on 32 years. I can't believe that it's been that long, but it has. We got married young, so we still have some youth in us even after all those years. I think Ashley's going to pop up a picture there of the family. So I have my oldest is my daughter. She actually runs the marketing department for us, and so that's a lot of fun being able to work with her. And then I have 3 boys. My oldest son is in the Air Force, and he is stationed in Japan, and we all went to visit him this year. And you can probably guess which guy there is in the Air Force, right? Talking about hair, pretty easy to see Hayden in his red shirt, and that's his wife, Taylor. And then my middle son, Tate, is there with the sunglasses, and my youngest son, Dexter, is standing there in the middle with his arm over his mom's shoulder there. And then Will is all the way to the far right, who is my daughter's longtime boyfriend. So that gives you just a little bit of an idea of about me, a little bit about the company. The company's been around for 11 years, Hughes Private Capital. We started in the time that everything was falling apart 11 years ago. And as of today, we have about 55 people that are on our team. About 15 to 20 of those people are in the Midwest, which I'll talk about, where we buy all of our homes. And the rest of them are here in Reno and work out of basically our corporate office here. So let's jump into what we do, and so you guys get a real quick idea of what that is. So we buy homes out in the Midwest. So we buy in really 3 main cities. It's Cleveland, St. Louis, and Birmingham. And then we're starting to buy now in Toledo and Akron, Ohio as well. The only places we'll ever buy is when we have our own people on the ground. So in other words, we have our own real estate brokerages set up there. We have our own property management people on there, and we have our own construction management. So, and when I say ours, it means that they're full-time employees of ours. So they are on our team and work directly for us in that manner. This is a big part of how we've become successful in doing this. Using third-party property managers or construction management, everything like that, becomes a very difficult place to be. And now that we're at about 750 homes or so in the portfolio, we're starting to hit more and more of the economies of scale. It took us to get to about 300 homes to be able to do that. So we mainly focus on what we call affordable homes in those areas. So most of the homes range about $75,000 to $100,000. And they have a very good rent ratio on them, meaning the amount of rent that we can collect on those homes is a nice ratio compared to the value of the home. And this is why we buy in the Midwest, because you can't get it like where we live in Reno or most places in the United States. You're not going to get that same type of rent ratio in there. So just a real quick, easy number, let's call it about an $85,000 home. We're going to collect $950 worth of rent every month on that, or sometimes better on that. And that's not, so that rent is representing greater than 1% of the value of the home. And that makes a big difference on what kind of return we're going to get. The other big reason that we buy in the Midwest is because these homes don't fluctuate up a whole day. They don't fluctuate up or down a whole lot. So when we got hit in the recession here in Reno, as you guys probably know that are on this call tonight, we saw values drop as much as 60%. Back in the Midwest, when you're buying these homes, you just don't see that same thing. Now, you're not going to get as much appreciation or much at all, really. But that's why we buy, because the timing of when we buy isn't super important to us. And as we look at this, it's just a cash flow play for us. We might get some appreciation over a period of time, long period of time, but that's not what we're trying to accomplish within this. It's always about the cash flow, and that's really where we gain the most safety, because no matter what's going on, people always need a place to live. They need the affordable places to live. And even during the downturn in the economy, and things that are like going on today, you're going to have these types of properties basically being full all the time, because people don't upsize, that's for sure. They downsize if they have to during that period of time. So that gives you a real quick, kind of overview. I'll let Ashley ask me a couple more questions, and then you guys can jump in at any time too and start to ask your questions as well.
All right, so Hughes Capital offers more than one option for recession-resistant investing. Can you give us an overview of those two options and where they differ or share similarities?
Sure. So yeah, what we do is there's really just two ways to, well, there's three ways, but one of them is sort of the same for both. So let's just talk about the real estate fund first. So we run a real estate fund. An investor can put X amount of dollars in. That X amount of dollars represents a pro rata share of the fund. At the end of each month, then you get your net profits based off that pro rata share that you own. And then you own everything inside the fund. So the fund today has about $25 million worth of properties. And so you own that piece of that all the way through. At the end of the year, you'll get a K1 from our RCPA, which you can put on your tax return, and you're going to also collect your pro rata share of the depreciation. So as of today, the fund is producing about 8.6% as a return. Now that can fluctuate a little bit, doesn't usually a whole lot. And then you get a little bit more on the depreciation on your K1. So you'll get another point and a half worth of return there. Your other way of doing it is to be as a secured portfolio, or a secured investor. Now, why do we call it secured? The reason why is we would sell you the home and put your name on the title of the home. Now, this is still a 100% passive investment, because what we do is we lease that property back from you, even though your name's on the title. We lease it back from you and pay you a set monthly income off of that. And we base that on how the whole portfolio does. So in other words, we may sell you 10 homes, your name's on 10 titles. That ends up securing you. That's where the security, being secured comes in. You do own those properties, but yet those properties really come back into our portfolio. And because we lease them back from you and pay you that set monthly income, all of the problems, all of the performance issues go back on us. So the only expense you have in that scenario as an owner is the owner's insurance. And that's your only expense. So in case the hot water heater breaks, we go out, we fix a hot water heater, and we pay for it. If the property is vacant, it doesn't matter. We still pay you the set monthly income that we've agreed to on that. Now, the way we can do that is because we're going to put those properties back into the portfolio. We've got 750 properties out there, and they're very well diversified across many geographical areas, as we talked about. And that way, we have a really good safety net and a lot of diversification. That ends up going over to your side on that. Now, one of the other things that we do a lot of with the secured portfolios is 1031 exchanges. So somebody owns a piece of property, an investment piece of property. They want to sell that piece of property, and they don't want to pay any capital gains taxes or any kind of the recapture their depreciation. And so they don't want to pay any taxes at all. They do a 1031 exchange. We can help you get that set up. Very easy to do. And then you exchange it in for some of the properties. And we do the exact same thing. We sell you X amount of properties, your name goes on title, that meets the 1031 requirements, and then we lease those properties back, and we go through that whole process of doing that. When it's all said and done, this is why we say be an investor, not a landlord. You don't have any of those landlord hassles. What we find too with the 1031 exchanges, which is always really interesting, is people have built up a whole lot of equity in their properties over time. So by the time they sell it and they move it over with us, they'll not only get rid of all those landlord hassles, but almost every time they at least double their income, if not way more than that. Sometimes it's way more than that. Just depends on the situation for that. So those are the few ways that you can come into the fund. You can do all of them if you want. Or, I mean, into the fund, into investing with us. You can do the fund. You can do the secured portfolio. You can mix and match if that's what you like to do. But the other piece of the secured portfolio, when you put your name on the title, is you also have the opportunity to finance the properties. And so we can set you up with a mortgage broker. You would get traditional, normal mortgages on that. And the beauty of that is that we can take the return and usually just about double it. Well, sometimes it's even more. But again, it depends on what's going on there. So if you're in the secured portfolio, I didn't mention that. If you're doing all cash, usually that ranges between about 7 and 8% return. If you finance it, you're going to get easily to 12 to 16% return because of where the money is today on the mortgages and everything else. So, all right, I'll let you ask another one, Ashley.
Well, this is a good opportunity to open this up to questions from everyone. So if you do have some questions, please feel free to post them in the Q&A box at the bottom of the screen. Just click on the little Q&A icon and you can submit questions that just come to us. They're totally anonymous and not shared with anyone else. But we do have a couple questions here already. So let's see. Okay, so this is a two-part question. Is it safe to take on debt right now to invest it? And could that debt become a problem during a recession?
Yeah, that's always a good question because so many people have, fear of debt, right? But, debt is either smart debt or dumb debt. That's what I call it. Dumb debt is when you take money out, you finance something that doesn't produce you income. So you might go get the ski boat, you might go get the RV, whatever it is, that's something that actually costs you money and doesn't make you money. Now, that's not dumb to buy those things, but if the only way you're buying them is with debt and that puts you at risk if something happens, then that's not the smartest type of debt you can use. For what we're doing and you're buying homes, that's very, very smart debt because, again, you're going to increase your return for those properties that you're buying. Mostly, let me give you a real quick example. Most of the time, and we stay pretty conservative on this, if you put about $100,000 down, just to use a number, we can buy about $300,000 worth, or you can buy about $300,000 worth of homes. So you're leveraging, right? So you only have $100,000 into it, but you own $300,000 worth of homes. Now, just because it's real estate, that doesn't make it smart. You still have to buy the right real estate. Because the real estate that we buy, as I've talked about before, is cash flow and not built on appreciation, then it becomes very smart to use that debt. So timing wise right now, it's a fantastic time. We're seeing that the rates are somewhere between about 3.8% and 4.1% on a beautiful 30-year loan with Fannie Mae. And that is, you're not going to get a whole lot better than that from that perspective. Now, let me just give you a little bit of the comparison real quick. If you bought a house here in Reno today and you wanted to rent it out, your chances of having positive cash flow is almost zero. And that's probably what it's going to be, is zero. You probably can break it even if you're lucky on that if you have debt. That's risky because as soon as you have a vacant home or something happens or changes, you are now, back to wondering what's going to happen. Your other thing that I'll point out there, that's not so much necessarily debt related, But anytime you own one of anything, maybe even two or three, those things really kind of put you a little bit more at risk too. Because if you own three houses and two of them are vacant, 66% of your portfolio is vacant and you're not collecting anything. That's the beauty of putting it together with the way we do it, and where you have 750 homes, you really diversify out all that risk, and you do it geographically and everything else, and that gives us a lot of safety in that portfolio.
All right, here's another question for you. This is one that I know we've gotten before, but who manages the properties?
Yeah, so we do all the management ourselves. Our full-time employees do that. We have property management in each one of those areas, and it really makes all the difference in the world as to the success that we can get within these homes, and the occupancy rate and everything else that happens. In each one of our places, we're very high in the 90% occupancy rate, sometimes as high as 98, 99% out of those that many. Now, it can get down lower, it can be in the 92, 93%. Never get that with a third party property manager. At least we never did. And everybody that I talk to that has used third party property managers, a lot of P's in that, isn't there? And they've always had really big challenges with that. So anyways, that's the way it's the only way we'll do it. As we move into new markets, and we will over time, and we'll continue to build this up. We're building at about 50 homes per month. We expect to have about 1,200 by the time we're done at the end of this year. We'll only move into new areas when we can open our real estate brokerage, have property management, and have construction management that all work on our team as full-time employees.
All right, I have another question here for you. Have we changed the fund return or discounted the rate of return because of COVID? Meaning, like, if renters don't want to pay during this time, how has that affected the fund?
So we're gonna see that, and it's gonna hit us somewhat. We don't know by how much. We're starting to see a little bit of that happening right now. Today is May 14th, and so May rents were due by the 5th. We're starting to see a little bit of slop in there, or whatever you want to call it, a lower paying rate. We're in touch with all of our tenants. We know which tenants are the good tenants, which ones are the bad tenants, which ones are the chronic late payers, all those things that are going on. We have a lot of tenants that get Social Security, that get disability, that are Section 8, so they're still getting government checks. That's not going to be affected. But we think, and no, we won't discount the return, because the return is what it is. So in other words, the return represents the net profit that we make each and every month inside the fund. So eventually here, as we do probably lose some or don't collect all of our rents, that's going to probably soften a little bit. It might go down by a few points on the return. I don't think we'd ever go break even. I'm sure we'd never go to a loss. That's just not going to happen. Well, I certainly hope not. Because the fact is, we might have some moratoriums on some evictions in certain places, but all that is starting to open back up. These people have to pay their rent. We're more than happy to work through it with them, but that doesn't mean that they don't pay the rent. And if they don't, then they can't live in the home. That's just part of the deal. I mean, we have expenses, and they need to find somewhere else to live because of that. So we'll see some of that maybe happening over the 60, 90 days, maybe a little bit longer. We'll see how that all pans out here. Nobody knows for sure, because there's no crystal ball for that for sure. But we're planning on it. But what we do know is it'll be only temporary. That's what we do know. And we've seen a pretty consistent return in the 8 to 9% range now for the last couple of years here. And as we grow bigger and bigger, that should be even a little bit more consistent, because there's just less fluctuation within the portfolio.
There's a bit of a follow-up to that, but are rents
Okay.
guaranteed with a secured portfolio?
So, good question. We would love to be able to guarantee them, but what we do is we call them a set monthly income. So what we do is we set up the portfolio for you, where we come to an agreement of what those are going to be, and none of this is ever a surprise, of course, as you move into it, and then you know how much you're going to get paid. Now, we base that on what it looks like for the whole portfolio. How's the portfolio performing? We could care less. Maybe this sounds like a kind of funny way to say it, but we could care less about your homes. If you own 10 homes, it just, we look at the whole 750. That's what we're looking at. Now, we have the right within our, it's called a master lease that we would lease the properties back from you with, is we have the right to adjust your rent twice a year. Now, so far, we've not ever had to do that, but there are times that that might happen, COVID being one of them. We're probably going to have to do some adjustment by 1 or 2 points coming up here as we move down the road here. Again, just being temporary on that. However, it's not just adjusting it down, it can actually be adjusted up too. So we're constantly, the beauty of it is that we're aligned with you as the investor. We want to produce the biggest return we can possibly do. What that does is it retains you as an investor, and it attracts new investors into the fund or be a part of the secured portfolio. So we're always working at that to always get better at what we're doing, collect more rents, lower our expenses, do all those things that can help out everybody and get the returns to stay as high as possible.
Okay, so how does leveraging work?
Well, let's say you're buying a house with us and it returns 8%. So that's all cash. So we sell you a house at $100,000, it's all cash, you make 8%. But if instead we could go out and borrow 200,000, so you could buy $300,000 worth of homes, but you borrow that 200,000 at 4%, which is about where we are today. All of a sudden now you can take that, because remember, you only have $100,000 in. That's the same amount. Now that leverages up your return, and that's where we can get you into the 12 to 16% range with all the tax benefits and everything that you get along with that. So it's a beautiful thing when it works, and it works really well with this, and it is a relatively safe way to go, because these properties, again, are all about the cash flow. It's hard to find properties with the higher cash flow when you do, especially when you leverage, because then you take on a payment. Well, in our case, we can still keep them. Well, they actually increase, but it's such a good cash flow that puts you in a strong position.
And does Hughes help with the leveraging process, or does the investor have to do that themselves?
Yeah, we try to do every single thing that we can for you, and because we try to make it as easy as possible. Again, we want you to be the investor, not the landlord, not have to mess with anything. But the fact is that you're going to have to do some work to get the financing. So we will put you in touch with some very good, we have two of them, so I say it that way, but good mortgage broker, and all they do is work with investors. And so, yes, you're going to have to go through the pain, and it is a pain to get the financing, because you got to give them your tax returns and all the other, all the documents. But the beauty is, once you're done, you're done, and you now own a 30-year loan on that, and it's a beautiful 30-year loan, and you're gonna make a really nice return on that. So yeah, and I say it's a pain. I always think of having to put all those things together as a real pain. But it's doable. You get through it, and you're done. And then after that, you don't have to worry about it anymore.
Okay, we have another question. Are there realtor fees, property manager fees, title fees, etc.?
So we always try to say that there's no fine print. So there's no realty fees, there's no property management fees. But the fact is that we take a property management fee off of the rent that we collect. So there is a property management fee. But however, why I say there's no fine print is because when we show you a return, whether it be on the fund or it's through the secured portfolio, that's already been included in there. So it's not like, oh, and by the way, there's something else that we're going to charge you for. So again, we look at everything as being our responsibility to produce the most transparent type of transaction for anybody that does business with us, and that's the easiest way to say that.
Another attendee asked, do we have to do LLCs to protect the houses?
Well, so when you get your owner's insurance, you're going to have $1 million of liability insurance. We believe that that's going to put you in pretty good shape right there. We have people do both, right? So you can own it in your name, you can own it in your trust, you can own it in an LLC. This is where I'm not an attorney. Should I advise you on this? If it's me, I like having an LLC, and I do most of my stuff that way. So that's probably one extra layer of protection if you want to go about doing that. It's not that difficult. You of course have to do your tax return for your LLC, but it is one more layer of protection.
Okay, another question is, what's the minimum amount to invest in the real estate fund?
25,000. So doesn't take a lot to get in there, and obviously you can do that. And if you want to do whether you're doing secured portfolio, minimum there is going to be more of at least buying one home. So you're probably in the $75,000 range to do that.
We have a quick follow-up to the LLC question, but do
Sure.
we help to facilitate setting up LLCs?
We can help a little bit. We can certainly put you in touch with somebody to do that. Believe it or not, it's actually very, very easy to set up your own LLC right on the Secretary of State's website. We do it all the time, but sometimes people feel like they need more help with that, and there's nothing wrong with that either. It just is going to cost you a little bit more, but yeah, we can absolutely put you in touch with somebody. But it's not what we do on a regular basis. Yeah.
Okay, well, that's pretty much our time for today. But Greg, do you have any final thoughts before we close up?
Just thanks everybody for coming. This is always fun to do. Always kind of weird to basically talk to yourself because I only see myself on the screen and Ashley. And so, it's not like talking to a live audience or anything out there and have any kind of a reaction. But, we're more than happy to sit down with you, whether it's over the phone. We can do a Zoom call just like this. We'll meet with you in the office. We'll wear a mask if you want us to wear a mask. We'll do whatever. We try to make it pretty easy and happy to answer any of your questions. We know that this is just a little bit of the tip of the iceberg to just give you a feel for what we do. So, yeah, I know, Ashley, you're going to tell them how they can get in touch with us. But other than that, thanks a lot for coming tonight and listening, and we hope to talk to you soon.
Thanks so much, Greg. So like Greg mentioned, we're happy to continue talking with you. We're going to put up a screen that shows you how you can get in touch with our team in just a minute. My colleague is going to pull that up for me. And we're looking forward to hopefully setting up a meeting with you soon. And if you would like to give us your contact information for the easiest way to get a hold of you, you can put that in the Q&A box as well. Like I mentioned before, that just comes to us, so no one else will see your contact information. You can give us your phone number, your email, however you'd like to be contacted. But I think that's it for tonight. So let me get that screen pulled up for you.
Thanks, everybody.
Yep, thank you so much. Have a good evening.